Hi, my name is Matthew Egan. I am the head of our full discretion product team at Loomis Sales, and I'm also the lead portfolio manager on our investment strategies that represent about $87 billion of assets under management. I am also on the board of directors. I've been at Loomis Sales for nearly 30 years. Structurally, my view is that inflation is embedded in the economy. We see, for example, demographic issues that are tightening the labor force and putting more demands on government spending in terms of entitlements. We also see a boom in capital spending related to AI and other investments, including climate and electrification of our energy grid. Lastly, we see geopolitical concerns around the world. Countries are concerned about security, and that's leading to symptoms like tariff wars, as well as increases across the globe in defense spending. All of these factors, we believe, are putting upward pressure on inflation on a structural basis. Cyclically, inflation in the United States has been bottoming. We think it's here at a bottom now. It has been slower over the last few months because of previous monetary tightening, as well as policies like immigration crackdown, DOGE spending cuts on the government side, as well as a trade policy adding uncertainty into the marketplace. Job growth had declined. We think that's behind us. Now the economy is starting to reaccelerate on the back of stimulus, both fiscal and monetary. And we think with that, in a lag basis, inflation will start to increase. At the moment, the Federal Reserve has paused on its interest rate cutting cycle, now that the balance between job stability and inflation stability is roughly balanced. However, there's uncertainty because a new Fed chairman is likely to be put into office as early as this May. Kevin Warsh is known to be an insider in terms of the Federal Reserve, meaning he worked at the Fed, so he understands how that institution works and how to work it. His view are not completely understood by the marketplace, but he has a very strong belief in productivity gains related to AI. And I think through that view, he's looking for the opportunity to continue the rate cutting cycle. Much will be dependent on the path of economic policy. But if we continue at these levels, I think he will argue on the Fed board for at least 1 to 2, maybe 2 rate cuts over the next 6 months. That may be difficult to do because he has to gain consensus. And I would also say he'd be in a very difficult position if inflation were really to start to become a problem later this year and he was put into a position where he had to possibly raise rates. Obviously, the administration led by Donald Trump would not like that. And so that would be an area of consternation and more pressure delivered on a Fed that's already been receiving a lot of pressure from the political pressure for the administration to continue to cut rates. The backdrop for investing in emerging markets is favorable in my opinion. And the reason I say that is because with monetary policy easing around the world and growth accelerating in many countries, that is a good backdrop for global growth. So with easing of policies, those other countries will be able to reduce or keep their interest rates low, keep their economies growing, and benefit from trade that will pick up. And also in addition to that, we're seeing firmness in a number of commodities that are denominated, obviously, in dollars. And with the weakness in the dollar, in terms of the dollar debasement theme, some of these countries that are strong exporters of commodities should seek to benefit. Now, I would caution that not all emerging markets are created equal. And when we think about the Iranian conflict, we have to be careful how we're allocating. So in our portfolios, we're really being very selective in the countries we're focusing on. We like to get a carry advantage, so where we can get a very high yield. We prefer countries that are a bit more removed from the trade conflicts that have risen and come and go, or that we think will persist. And then we're looking for those that really have strong commodity positions. But with this Iranian conflict, we really want to make sure we're invested in countries that are not too dependent on importing oil. If oil prices remain high, or if there's more disruption, that could be very painful for particular emerging markets. So when I look around the world, there's areas like Turkey that might benefit, South Africa, certain Asian countries like Uzbekistan, then looking into the Latin America area where they're rich in both petroleum and other types of commodities, I think look attractive. When we look at today's backdrop, we think it's more important than ever to be diversified in your fixed income portfolio. At Loomis Sayles, we've always preached to take a multi-sector approach, cast a wide net, diversify your fixed income holdings. We see value today in the emerging market space. You have to be very selective, stay away from oil importers at the moment, but look for countries where the fundamentals look decent, the yield pickup is significant, and where the countries tend to have more commodity-based export exposure. When we look at credit spreads, we see that in many parts of the world, spreads look optically tight. But I would say, for example, in the United States, corporate fundamentals are quite strong. The strong economy is bolstering profits. So the health of corporate America is strong, and that will keep default rates and losses from downgrades to be very, very manageable. So while spreads are tight, losses are also going to be low, even if the economy were to weaken on the margin. And so the spread premium, the difference between the spread and the losses that you're at risk for, still looks reasonably good to lean in to spreads really across the board, for example, in the United States. We favor certain high yield areas, and then secondarily in the bank loan side, there's some good bank loans to pick in that space. Investment grade credit, all on the public side, look attractive, as well as securitize. Those securitize are asset-backed securities where the underlying security are things like commercial assets, airplanes, things like that, as well as consumer loans, with the US consumer being in very good shape. So all those areas are going to give a bump in your income in your portfolio, your yield, and we think out-yielding a benchmark or getting the highest possible carry with optimizing on your loss basis is going to really lead to compounding of returns over time. And that's the nice thing about investing in fixed income today relative to a few years ago. Your starting yield is much higher. So we're building portfolios today with 5% or more, depending on the risk tolerance of yield. And that yield acts as a nice shock absorber to the volatilities in the market. So you can take more risk, you can lean into risk. The advice I give investors for 2026 is stay invested, look for a pickup in yield. I see the possibility of inflation re-emerging, so keep your maturity profile on the shorter end. I advise a duration, for example, of somewhere around 4 to maybe 5, or even a little bit shorter than 5, I think is ideal. Try to roll down the yield curve and try to get to that, what we see as a higher level of yield, by rolling your maturities and pushing them out the curve as rates rise again. I think it'll be a relatively mild pickup in yields if it does happen. I see less propensity for a declining yield environment or big cap gains from the yield curve. So it's all about, in this market, in a range trading market, it's all about getting income. I still think you want to lean into spreads and risk to pick up extra income. That'll be the place to be. The public market in the credit space is still quite healthy. We see losses remaining quite low. There's some rumblings in the credit, but the markets, there are excesses in the credit. The losses are going to pick up, but those are really in the private space, private credit space, which is really de-risked the public space. So I think the investment backdrop is quite attractive. And like I say, what you're really getting out of a nice fixed income portfolio is that ballast, that income, that liquidity that you need in a diversified portfolio, With today's yields, we can have a really strong investment grade rated portfolio with a 5 or even 6% carry, depending on how much risk you're willing to take.
投资一定有风险，基金投资有赚有赔，申购前应详阅公开说明书。